so we're going to go to our first speaker of the night. We're going to hear about some accounting, and I'm kind of excited to hear about this. They've got some cool things to talk about. So Rose, one thing that Rose told me that actually really stuck out to me is that they're experts at negotiating debts or taxes owed with the IRS, okay? If you were an entrepreneur and you're self-employed, you're in this business long enough, you will eventually get audited. It's not an if, it's a when. You'll either trip some flag or you'll just get selected for a random audit. And random audits are not fun. Okay, not only do they make you dredge up 7 years worth of crap, but they're always going to get you for something. Unless, of course, you hire Rose. I think Rose negotiated down, what was it, almost $60,000 in debt with the IRS in a settlement. Pretty impressive. She specializes, she doesn't take a ton of clients. They specialize in entrepreneurs, real estate investors, specifically why they're here tonight, okay? They work with you. They know how your properties work. They know how your job costing works. And really, the fact of the matter is every single person in this room has bumped up against the problem of you have to show enough income to get loans and want to show little enough income that you can afford to go buy a house, right? That's a hard line to walk. And if you don't get your accounting in line, you're not going to be able to grow. Every single investor in this room, and there's at least 15 that are above the $10 million mark that I see in the room, will tell you if you ask them that the second that they got really organized about their accounting, which is code for outsourcing it, because let's be honest, most entrepreneurs suck at accounting. It's our weakest skill set. That's when they were really set up with a foundation to springboard. So please give a warm welcome for Miss Rose.
Thank you, Dakota, and thank you, Marty, for inviting me out here. And I look forward to speaking to everyone about the exciting world of taxes and accounting. I hope to not be dry, and my goal here is for you to gain something out of this, other than just the 27 and a half years of depreciation, right? A little bit about me. I'm an enrolled agent. That means my license is federally issued. I can represent taxpayers at all levels of the IRS. I am an entrepreneur. I've owned a lot of different businesses. I own real estate. And most recently, my partner Stephen and I opened up Chiba Hut down there on 23rd Street in Uptown. This is my shameless plug. I did bring a box of munchies back there for your enjoyment. I've been an accountant for 20 years, both in the public sector and the private sector. I really enjoy working with small business owners. That's where it's the most fulfilling, because you have the most opportunity to make real changes if you want to. Like I said, I'm just an entrepreneur who loves numbers. It's the backbone of me, and I'm always curious. So let's get to it. Before we get into the 27 and a half years depreciation, it's important for me that everyone kind of understands how our tax system works. This may sound really basic to everybody, but I run across very successful entrepreneurs all the time who do not understand our tax system. And with the current legislation, and you as business owners, you might be paying a lot of tax. It's important to me that you know. So we have a progressive tax system. This right here is our current 2025 rates for a married filing joint couple. You file together. So this means that at the first $23,000 of income, you're at 10%. The next bracket up to $96,000 is at 12%, and so on and so on. So when your accountant says to you that you are in the 5% bracket, that doesn't mean you're paying tax on 100% of your income at 35%. We also have the standard deduction. The standard deduction is set every year by Congress. For 2025, it's $15,000 for a single and $30,000 for married. That's the highest it's ever been. That's adjusted every year for inflation. Let's see. Oh, you got. So let's talk about deductions versus credits, because sometimes they're used interchangeably and they're not the same. So a deduction is something that reduces your taxable income. So you, for example, you're a business owner. You paid to get into this REIA, maybe, I don't know. But since that helps your business, it should be a deduction to your business. Keep track of that. Tax credits are applied or directly against your tax liability. So they are dollar for dollar reduction. And I have a really easy example here. You have a $1,000 deduction and you're in a 22% bracket. That's not $1,000 in tax saving, it's a $220. Versus a credit, it's $1,000 tax saving. I figured we'd take questions at the end, keep it more interactive then. So like I said, tax credits are more impactful. We have the earned income credit, child and dependent care, residential energy credit, lifetime learning credit. There is a lot of credits, surprisingly, a lot more than you would think. I had a client that engaged with me last year, and we did a review of their prior year tax return, and we got to talking, and it turns out they adopted 2 children, and they missed out on the adoption credit. And that was a significant credit. We went back and amended, and we are still in the process of getting back that refund. But it's also important to note that the states have credits too that are related directly to the state. So I ran into one today that the state of Oklahoma knew for this year is a caretaker credit, which is $2,000 or $3,000 just for caretaking for somebody. So always, it never hurts to ask your accountant. I always make sure that communication is a two-way street, right? Because they don't live in your day-to-day life. They may not know, you may not even talk to them until tax season, right? All right, so employees, different income types and tax. Employees earn money, pay taxes. We have business owners who earn money, spend money, pay taxes. And we have real estate investors who earn money, invest money, and they pay less tax because their income is not taxed the same as business owners. It's considered passive for the most part. Oops. So we have business owners who have self-employment tax. This is your ordinary income. So think of like, I'll use Travis here as an example. You have a landscaping company. That's considered ordinary income. If depending on his entity type, he's going to pay income tax plus self-employment tax of 15.3%. You also have QBI, which is qualified business income deduction. Trump introduced that in 2017, and I believe it's going to expire at the end of this year. So then we have real estate investors who their income is taxed as ordinary income, but you don't pay that self-employment tax. You still get that QBI, and if you sell a property, you'll be subject to capital gain tax. Fun fact, Oklahoma, if you hold a property for 5 years or greater, you could be exempt from that capital gains tax on the state side. That's something I often see missed as well. We have long-term and short-term capital gains rates. So if you hold a property, a buy and hold property for less than 1 year, that's going to be subject to short-term capital gains, which is your ordinary. So if you were in the 22% bracket, that would be taxed hypothetically at 22%. As opposed to long-term, if you hold that for more than 1 year, depending on your income level, these are capital gains rates for 2025, you could pay 0 tax. So sometimes the timing is really important when you are looking to sell an asset. If you have 6 months left to that 5-year mark, it might make sense to wait. Okay, here's the fun 27 and a half years. Does everyone kind of understand depreciation? You buy a property, we don't deduct, for tax purposes, you don't deduct the principal payment. that you're paying. You can deduct interest, but the reason they don't do that is because you're getting depreciation. So that's the value of that, the purchase price of that property spread out over 27.5 years. I didn't make up that number. The IRS made up that number. Commercial properties are over 39. And I always say that, you know, depreciation must be recaptured when it's sold. So that's why it's a good idea that you always have bookkeeping, because at any time you know what your book value is of that asset. You know, I purchased it for 100. I've taken 50,000 of depreciation. Your book value is 50,000. Oh, look, here's an example. So yeah, for this example, you've held it for 5 years. You've got 15,400 depreciation. Your tax basis is now 84,000. And if you go to sell it for 125, you have a gain of 40. And depending on your income bracket, your tax would determine that. I put an image of a bucket of water here because as a reminder for me that I think of depreciation as when you buy a property, you have a full bucket of water, but then every year you're taking a little scoop out. And then when you sell it, you have to fill it right back up. I don't know if that analogy works for everyone, but it does for me. All right, cost segregation, has everyone here heard of that? Mm-hmm. Everyone done one? No? Okay. So the goal with a cost seg is to spread the pieces of that property out over different lives of it. So instead of taking your asset at 27.5 years, you have a cost segregation study done, and you can break up the electrical 15 years, perhaps the flooring in 5 years. You know, all these different components that will give you a significant amount of depreciation in year one. I always say that, okay, you can DIY your cost seg study. You absolutely can. There's websites out there where you can do it yourself, but I always recommend going through an engineering firm to do a cost segregation study. Also, before you pull the trigger and do a cost segregation study, talk to your accountant, because you may not need to do it. You don't need 100,000 of depreciation. Maybe you're not able to even take 100,000 of depreciation. It all just depends on your situation. Some other tax deductions, of course, home office, where you can take a simplified method, which the IRS allows for $5 a square foot, or you can take an itemized method where you add up all of your components of your home office, like your utilities and your security and mortgage interest and all those things, and take that as a deduction. One thing I will note is that the home office deduction is only available if you are profitable. Sorry, I guess if you're not making money, you don't have a home office. I also like to bring up, all of these things are, everyone's mileage varies. So when someone says to you, hey, I didn't pay any tax. Okay, well, their situation may be different than yours. So it's okay to reach out to your accountant and say, I heard this thing, and they should be able to educate you of like, hey, I really love that tax deduction, but it doesn't apply to you for XYZ. Or, hey, I really love that tax deduction, but we need to make XYZ happen in order for it to apply for you. So being able to just think outside the box, right? Hiring children and grandparents. I say grandparents only because you're looking for people that don't have any other income or taxable income. So the standard deduction is $15,000 for 2025. So that's the most that you can pay a dependent without them having to file a tax return. This is really one of my favorite tax strategies, especially if you have young kids, because it allows you to pay for some of their expenses and it's a deduction. So for example, my daughter is 9 and she gets a W-2 from my S Corp. She does do jobs, small tasks within, several of my businesses, and she gets a paycheck, and that goes directly deposited into her bank account. In turn, I take that money and I use it for a Roth, or I use it for her summer camp, or whatever I need it to use for. But I've already deducted it from my business as an expense. Now, depending on the age of your children, you may get a letter from Social Security, and that's okay. You just need to respond to it. That Social Security letter is going to ask what they do and things like that, their age, which they already know, but mostly their job. So, as long as it's reasonable, we're not paying our children $50,000 unless, market values hold up to that. So I think that's a fun little tax deduction. Is anyone here paying their children? As a W-2, not a 1099, because that's different. Okay. And always we want to maximize depreciation. Bonus depreciation this year is down to 40%, and next year it's going to be 20%, unless Congress changes that. It used to be 100. Okay. Real estate professional. I like to talk about this one because a lot of times I hear, I am a professional. Well, I'm a professional too. It doesn't mean I'm a real estate professional. When you have other income, and the IRS does consider real estate passive, the most that you can deduct is $25,000. But if your other income is over $150,000, you can't take any deductions. It doesn't mean they're lost; they just carry over until you sell that property. So the only way to avoid that is to establish that real estate professional status. And the IRS has a lot of steps to qualify for that, such as working 750 hours in your business, material participation, so you are actively involved in the business, you don't have a property management company that's using it. Discuss with your accountant about that, as because everyone's mileage varies. And also keep in mind, and I think Dakota mentioned it, that your taxes are your borrowing power. Unless you have private money or you have enough assets that you can take, that you're liquid enough that you can borrow from, a lot of times mortgage lenders unfortunately like to look at 2 years of taxes, and they like to see inclining income. When you are taking that real estate professional status and you also did a cost segregation, you might have a significant amount of depreciation, meaning a significant loss on paper. Doesn't mean you lost money, but on tax return, you did. So always keep that in mind and keep that communication open with your accountant. They may want to know 2-3 years down the line what you're thinking, because it could impact you. Also, are you a dealer or are you an investor? Because they are taxed differently. If you're flipping houses, you're a dealer, and you're not going to be subject to those passive activity rules that buy and hold investors are. You may want to consider different entity depending on how much revenue you're doing. Same thing if you're out buying deals and wholesaling. So one of the things I love about real estate is that there are so many different ways to make money, but a lot of them are taxed differently too. So
is there a specific number of flips that changes you from a dealer to something else?
Yes, so his question was, is there a specific number of flips that changes you to a dealer from something else? The answer is no, but the IRS always looks at intent. So a lot of times, as real estate investors, you may buy a property because it's a good deal, or the time was right? You don't know at the time that you're going to flip it. You might buy and hold it. Hell, maybe you even bought it to buy and hold, but you couldn't find a tenant, so then you sell it. These are all real life situations, right? That's the intent. So I would say, and the way I deal with my clients is like, are you in the business of flipping, or is this a 1-2 off thing? If you're in the business of flipping, and your intent is to go out and find houses to flip, you most likely would be considered a dealer. And then we need to look at your how often you're doing that, what kind of revenue you're making, and perhaps even look at a different entity structure. Things you can do now. Bookkeeping is a big one. And when I say bookkeeping, your property manager is not a bookkeeper. The report that they send you at the end of the month is not bookkeeping. Bookkeeping is having all of your assets and your liabilities recorded correctly, your assets recorded properly. That's the only way you're going to have real-time numbers. And also, without bookkeeping, your tax time can be really messy. You may be including principal payments in your deductions and sending that to your accountant. If you're, I think I told Dakota earlier too, bookkeeping is chess, bookkeeping is chess. No, bookkeeping is checkers, accounting is chess. That's what I said earlier. So thinking of how, every entry in accounting is double-sided. You have an expense. How did you pay for it? Was it a credit card? Oh, that goes on a liability. If you're just writing off your credit card payments, you could be missing out on deductions because unless you're paying the credit card in full. But anyway, I cannot stress bookkeeping enough. W-9 forms for your contractors. I know 1099s just went out this year, but it's a big one, and I'm guilty of it myself too. When you go and pay someone to do painting and you pay them, you never see them again, but technically you should have gotten a W-9 and you sent them 1099. It doesn't mean that it's not deductible for tax purposes. It just means that if you were in a worst case scenario like an audit, they could potentially throw that deduction out. Your entity, I kind of touched on that with flipping and wholesaling. Again, depending on your income levels, an S Corp may be ideal. I'm curious to see what this legislation does. There's been talks of C Corp moving down to 15%. If that happens, wow. I mean, I could see S Corps converting to C Corps, but it's just, time will tell. Talk to several different accountants. See if they match if their communication style matches, or if you're someone that needs to sit down in front of somebody, get that out, or are you okay with virtual, all those things. And tax preparation does not equal tax planning. So tax planning is something that takes place year round. Tax planning is being able to reach out to your accountant and say, hey, I'm thinking about doing this with this property. I'm thinking about selling it on installment. What would that look like? Okay, well, when you sell it on installment, you got to recapture all of that depreciation in year one. What if you had held it for 10 years and you had $50,000 of depreciation? Well, I would make sure that my down payment covered the tax for recapturing that depreciation. That's tax planning. Tax preparation is handing everything over to your accountant and then putting it in the box in the correct form. So yes, I feel like we really touched on high level things, but my goal was for you to change your mindset a little bit with accounting and just think of it as more of it has to be involved in your business day to day and not an afterthought. Any questions? Marty?
In regards to the 1099s, there's no penalty from the IRS. It's just I just lose the deduction.
No, there is penalties from the IRS for late filing. It's $30 for 31 days late, and then it goes up to $60 for 30 to 60 days late. Yes, there's penalties. Now, it's also only vendors that you paid with cash or check. I believe Zelle is included in that too, because it's not a third-party app. But if you paid them with like Venmo, PayPal, Cash App is responsible for sending those 1099Ks out. So, but if you're going to do that, make sure that you have a business bank account attached to your Cash App, Zelle, PayPal. We want to avoid commingling. Back there.
Can you talk more about some of the tax credits for real estate and also the QBI? I was interested in that.
Yeah, so tax credits do not necessarily apply just for real estate investors. These are overall tax credits. So it like the child tax credit, that's $2,000 per dependent under the age of 17. If you go back to school, we have the lifetime learning credit. There's not necessarily credit specific to your business. It's just part of the overall income tax. And then QBI, also known as qualified business income deduction, that is a 20%. So on your net revenue for business or real estate, it's an additional 25% deduction. It's not a credit, it's a deduction. So it reduces your taxable income. And that was introduced in 2017, but could expire.
So that's something that can be taken every year?
Yep. Yep. Yes, sir.
You mentioned about hiring our kids as a W-2, so what about as a 1099? What if I had a partnership, hold a lot of properties, go
Yeah.
more them for me and I will pay?
So his question was on paying children as a 1099 versus a W-2. This is a two-part answer because it depends on how old the child is. If it's a minor that's filing their own tax return and doesn't have any other income, I would say no, because now you're creating income tax on that. Because the 1099 income not only has income tax, but it also has self-employment tax. And we want to try to avoid that 15.3% if we can. If they're an adult and they have other income and they, you don't want to pay the payroll taxes on it, maybe a 1099 makes sense. It just depends. For the example that I provided with the child, it's a W-2 all the way. Okay, did anyone learn anything here, anything new, or give any additional things to think about? And accounting is fun and exciting. Did you have a question there? Okay, perfect. Oh. Okay.
Are you familiar with the solar tax credit?
Yes, solar tax credit.
So I know there's a 30%.
It's 30% of the purchase price.
Okay, I heard there's a way to get 60%.
I believe it depends on what it is. So, yeah.
I want to get with you after that.
Okay, yeah.
Do you do taxes just in Oklahoma, or can you do it for other states?
We have several clients that are out of state. Yeah. Okay. Okay, one more.
My partnership here in Oklahoma,
Uh-huh.
and I bought other properties like in Missouri and Kansas.
Uh-huh.
So will I have to do like income tax in these states for myself, or I just get the K1? Like how this will work? Out of state?
Are your properties are located out of state? Depending on the state, you may have to have income tax there as well. But it could be possible that the partnership pays it instead of you personally.